All right, let's talk Dine Brands. You know them. They're the parent company behind two absolute giants in the restaurant world, Applebee's and IHOP. And their latest earnings report just dropped, so we're going to break it all down.
So here's the thing. On August 6th, Dine Brands came out with some pretty good news. The revenue was higher than anyone expected. But, and this is a big but, their stock price took a hit. So what gives? That's the puzzle we're going to piece together today.
And it wasn't just a little dip either. We're talking a drop of as much as 7% intraday. That's a pretty clear signal from Wall Street that they were looking past that shiny revenue number and seeing something, well, something they didn't like hiding underneath.
And right here, this is the core of the whole story. It's this classic tug of war. Revenue comes in strong, beating what the analysts predicted. Awesome, right? But then you look at profit, and it actually missed expectations. So the money came in the front door, but a big chunk of it slipped out the back. The million-dollar question is, why?
To figure that out, we've got to unpack the financials a bit. And to really understand what's going on with their profits, we need to look at a key metric called EBITDA. It helps us see how healthy the core business actually is.
Now, EBITDA sounds complicated, but just think of it as a quick snapshot of a company's operating profit. It basically shows you how much cash the business is making before you get into all the weeds of accounting, financing, and taxes.
So, for the quarter, Dine Brands pulled in $56.2 million in adjusted EBITDA. But, a number like that doesn't mean much on its own. It's all about the context.
And boom, here's the context that really matters. That $56 million is way down from the $67 million they made in the same quarter last year. And remember, that's despite having higher sales this year. So where on earth did all that profit go? Well, it was kind of a perfect storm. You had rising overhead costs, the day-to-day expenses of running the company. IHOP had a pretty weak quarter, which dragged things down. And this is key, they're actually choosing to spend more money right now on things like remodeling and their new dual brand stores.
This really brings us to the split personality of Dine Brands this quarter. I mean, it was truly a tale of two completely different restaurants telling two completely different stories.
And to see just how different they were, we look at a little thing called comps, or comparable sales. It's a super important metric that basically asks, are the restaurants that were open last year selling more or less stuff this year? It's a great way to measure a brand's real health.
And wow, look at this chart. It tells you everything you need to know. Applebee's is absolutely crushing it, with sales up almost 5%. That's huge. But then you look over at IHOP, and sales are actually down more than 2%. I mean, that is a massive split for two brands owned by the same company.
So what's the secret sauce at Applebee's? Well, they leaned hard into value. That whole 2 for $25 deal is a huge traffic driver. In fact, they saw more customers walk in the door for the first time in over a year. That is a massive win in today's market.
Now, IHOP is a different story. It's clearly in turnaround mode. Yeah, that negative sales number looks bad, but there are some signs of life. For one, their customer traffic is actually better than the industry average, and their own value menu is starting to work. It's a work in progress.
So, okay, they know there's a problem, especially at IHOP. What's the plan? Well, management laid out a pretty clear strategy. It's all about fixing the basics and then making a big bet on something new.
For IHOP, it's all about getting back to basics. They're cutting way back on all those complicated, limited-time offers and using new tech to speed things up. And it's working. They've already shaved an average of 4 minutes off how long it takes to serve a table. In the breakfast world, that's everything.
Okay, but here's where things get really interesting and maybe a little bit wild. They're testing out these new dual-brand restaurants. Think about it, an Applebee's and an IHOP under the same roof. The CEO, John Payton, said that right out of the gate, these new spots are doing 2 to 3 times the sales of a regular restaurant. If they can scale this, it could be an absolute game changer.
So you've got a clear plan. You've got this exciting new restaurant concept. So why did the stock still drop? Well, it all comes down to what they told investors to expect for the rest of the year.
And this table just lays it all out. Look, they're raising the sales forecast for Applebee's. That's great. But they're also saying their corporate costs are going up. And the net result of all that is right there at the bottom. They are lowering their overall profit forecast for the entire year. That's what spooked investors. Now, the CEO, John Payton, came out swinging. He said their plan is working, and he pointed to all the good stuff happening at Applebee's as proof. He's confident. But at the end of the day, investors looked past the confidence and focused on the hard numbers. And the message they got was pretty simple. This growth is going to cost more and be less profitable than we thought it would be just a few months ago.
So when you put it all together, the sales beat, the profit miss, the two-faced performance of the brands, and that lower forecast, you're left with one central question, one big challenge for the whole company.
So, that's the big question, isn't it? Can Dine Brands keep pulling people in with these value deals and cool new ideas, like the dual brand stores, and do it efficiently enough to actually grow their profits? It's all about balancing that growth with rising costs. They have to nail that balance if they want to win in the long run. And, as always, this is not financial advice.